Hi everyone, welcome back to my YouTube channel. This is Raz, and in this video, we will continue our discussion about deductions from the gross estate, particularly the transfer for public use and the vanishing deduction. So if you're ready, let's start. So in our previous video, we have discussed already the items in the concepts of allowable deductions from the gross estate, and in fact, we have discussed already the losses, indebtedness, and taxes, or simply called the lit. Okay, so now we will discuss the transfer for public use and of course the vanishing deduction to complete our discussions about ordinary deductions. Okay, we will discuss these two items, and we will have another two videos for the family home, the benefits received under RA 4917, and for the share of the surviving spouse. Okay, so let's begin with transfer for public use. This transfer for public use are donations and contributions by virtue of the death. So basically, these are transfers. These are gratuitous transfers, which only happens upon the death of the decedent. This may be donations to government or its political subdivisions like LGUs, or it could be a donation to a non-government organization such as Philippine Red Cross, charitable institutions, education institutions, religious institutions. So those organizations could be the recipient of these contributions or donations. And also, of course, charitable and religious institutions. Take note that these organizations, the non-government, the NGOs, and charitable institutions or religious institutions should be duly accredited to be qualified for deduction. Okay? Provided that this transfer, this donation, should be indicated, stipulated expressly in his last will and testament. But there are some conditions to be qualified for the deduction against his gross estate. So these are actually exemptions from the estate tax, provided that not more than 30% of these donation or contributions are used for admin purposes. So if the donation is in form of cash, then not more than 30% of that cash donated should be used for admin purposes like payment of salaries, payment of electricity, utilities. Okay, so those are admin expenses. That is why when claiming transfer for public use as a deduction from the gross estate, the BR would require a liquidation and a sworn statement from the recipient that really actually they use the entire amount for the purpose of its operation and not for admin purposes. Okay? Also, another requirement, the income of such institutions does not inure to the benefit of the private individuals. This means these organizations, these non-government organizations or government organizations or charitable institutions should not use or distribute any of its income, because basically they are for non-profit. Okay, they are non-stocks, they are non-profit, they are non-government, and no amount of income, assuming there is an income arising from that operation, should not be distributed among the members of that organization, because basically the organization is not for profit. Example, Juan, on his last will and testament, made a donation to the Philippine Red Cross in the form of cash amounting to 2 million and a transfer of his idle real property to the city government of Butuan. So there are two transfer for public use here. Number one, to Philippine Red Cross, and number two, to the city government of Butuan. The property has a fair value of 10 million pesos. And all transfers will be taken from the estate's free portion. So no amount of the legitim is used or is compromised with these two transfers. So how will these transfers be exempted from the estate tax? So of course, if these transfers should be claimed as a deduction from the gross estate, first rule, this transfer, this property, the cash, the property, should be added first in the gross estate of the decedent. Okay, because how can we deduct something if it is not in the gross estate, right? Second, that the recipients, the Philippine Red Cross and the city government of Butuan, should use this entire amount for the sole purpose or for public purpose. And if there is any amount used, that should not exceed 30% of the amount. So here are the answers. The donation to the Philippine Red Cross, a cash donation, and a transfer to the city government of Butuan, the real property, will be both exempted from the estate tax and thus be deducted from the gross estate if the following conditions are met. Not more than 30% of the cash donation are used for the admin purposes, that is for the donation to the Philippine Red Cross, and not more than 30% of the property donated is used for admin purposes, and that was pertaining to the property donated to the city government of Butuan. And finally, the income of such institutions should not inure to the benefit of any private individuals. Okay? So those are the conditions for the transfer for public use to be deducted from the gross estate as an ordinary deduction. Now let's talk about the vanishing deductions. Why is it called the vanishing deductions? Okay, vanishing deductions, also known as the property previously taxed, are allowed to be deducted from the decedent's gross estate, but the amount to be deducted are diminished depending on the year's gap from the prior transfer. So you might get confused. There was a transfer and there is now a transfer. Let's have a situation. Juan died on November 1, 2018 and transferred his only property left to Pedro, his son. 3 years later, Pedro died due to a car accident, and the only property left by Pedro was that same property he inherited from his father, Juan. So there are two deaths here. First, Juan, the father, died on November 1, 2018 and transferred his only property to Pedro. Now, 3 years later, Pedro died due to car accident, and the only property that Pedro left was the same property that he received from his father. When Juan died, the property was subjected to estate tax, right? And now, when Pedro died, it will be again subjected to another estate tax. That is not double taxation. Why? Because the first owner in 2018, that was the father, and now the owner is Pedro. Though the property is the same property, but the owners are not the same. There is no double taxation in that, because what is being taxed in estate tax is not the property. Remember, estate tax is a tax on the right to transfer the property gratuitously upon the death of the decedent. Therefore, what is being taxed here is the right of Juan and the right of Pedro, and not the property itself, right? So there's no double taxation here. So there was no double taxation. There was no direct duplicate taxation. This is actually not prohibited by our law, but somehow it constitutes an indirect duplicate taxation, right? So in this case, the property from the first transfer from Juan to Pedro was already subjected to transfer tax, and that was the estate tax. And 3 years after, the property will again be subject to another estate tax when Pedro died. Therefore, we can have a vanishing deduction. What is a vanishing deduction? The purpose of vanishing deduction is to minimize the effects of a double tax on the same property within a short period of time. Again, there was no direct duplicate taxation. There is a double tax, but that was only an indirect duplicate tax, not a direct duplicate tax. So therefore, to minimize the effects of the two taxes imposed from the first transfer to the second transfer, the second decedent could could claim a vanishing deduction. So we have here several conditions for allowance. Number one, the property is forming part of the gross estate of the present decedent and is situated in the Philippines. You cannot claim vanishing deductions if the property is located outside of the Philippines. Remember, the purpose of vanishing deduction is to minimize the impact of the estate tax or transfer tax. Therefore, if it is located outside the Philippines, then there's nothing to minimize, right? So therefore, the property must be added in the gross estate and the property should be located in the Philippines. And another, we have the present decedent acquired the property by inheritance or donation within 5 years prior to his death. So when we say vanishing deductions, this does not apply only to inheritance. It also applies to donations. So any gratuitous transfers within 5 years prior to the present death, that could be claimed as a vanishing deduction. So whether the property was received through inheritance or through gift, as long as a prior transfer, either inheritance or gift, and today's death is within the 5-year duration. And the property was previously taxed upon inheritance or gift. So the very purpose of vanishing deduction is, of course, to minimize the effect of double taxation, direct, indirect duplicate taxation. The property to be qualified for vanishing deduction should have been subjected already to estate tax or donor's tax. The amount of vanishing deduction. The amount to be deducted as vanishing deduction may be claimed as follows, depending on the interval between the prior transfer, either inheritance or gift, to the death of the current decedent. So we have here the 5-year period. Again, the date of the current death of the present decedent and the date of the transfer should be within 5 years. The transfer could be gift or could be inheritance. Okay? And it is said that if the date of death and the prior transfer is just within or not more than 1 year, then the entire amount could be deducted from the gross estate. If the date of current death and the prior transfer, either inheritance or gift, is more than 1 year but not more than 2 years, then only 80% is deductible, and so on. Let's have an illustration. The following information is provided by the executor of a married decedent. We have here exclusive property, and the fair market value of this property, which was inherited 3.5 years ago, was 1,450,000 pesos. And this property, when inherited, was subjected to a mortgage of 450,000 pesos at that time. This decedent received this property for a fair value of 1.450. At the same time, he was asked by the giver of this property to pay the corresponding mortgage, for which he gladly assumed. Okay, so he assumed the property, at the same time he assumed the mortgage. Now, the fair value of the property at the time of his death today is 1.3 million pesos. Meanwhile, conjugal properties of the decedent husband and the surviving wife is 4.7 million, and there was an unpaid mortgage on the inherited property of 350,000 pesos. Therefore, when the property was inherited, the mortgage was 450,000 pesos. But today, upon his death, the unpaid mortgage is only 350,000 pesos. Therefore, there was already a payment of 100,000 pesos. So, we can say that before his death, he has already paid a total amount of 100,000 pesos. reducing the mortgage from 450 down to 350. There were also judicial expenses incurred after the death in connection with the estate settlement and of course other unpaid obligations of 570,000 pesos. So we are asked to compute the vanishing deductions. So this a problem will actually involve several steps and we will go through step by step. Okay, step 1. The first step is to compute the gross estate. So in this problem, there is no complication because there are only two properties given, and these are the exclusive property and the conjugal property. Okay, so though we have here another 3 items, but actually they don't matter because they are not properties. They are actually deductions, claim deductions. Remember, in computing the gross estate, our basis in computing the gross estate is the fair value of the property at the time of death of the decedent. Therefore, for exclusive property, the amount to be included in the gross estate is the 1,300,000. Not the 1,450,000, because that 1,450,000 was the fair value of the property 3.5 years ago. That was the time when he inherited the property, but today, at the time of his death, the fair value is only 1.3. Also, for conjugal properties, there's no complication. It's of course the 4,700,000. Therefore, 1.3 in 4.7, that is actually 6 billion. Our total gross estate is 6 million pesos. 1.3 exclusive and 4.7 conjugal. Easy peasy, right? So that was the first step. And the second step is to determine the initial value of the property previously taxed. So now let's focus on the value of the property. And as we know, there is only one property which was previously taxed, and that was the exclusive property. You might be asking, what is an initial value? The initial value is the lower between the fair value at the time of transfer, whether gift or inheritance, and the fair value at the time of death of the decedent. So take this for example. It is said that the fair value of the property when inherited 3.5 years ago was 1,450,000, and the fair value at the time of death of the decedent today is 1.3. Therefore, we will compare which of the two values given is the lower figure. Comparing between the fair value at the time of transfer 3.5 years ago and the fair value at the time of death today, the fair value today is the lower amount. Therefore, between 1.450 and 1.3, it's the 1.3 that we should use as our initial value. Remember, we are claiming for deductions, and deductions are highly disfavored by the law. Therefore, it will always be whichever is lower. Remember, when we are talking of fair values, it should always be whichever is higher, because that was subject to tax. But when we are talking of deductions, it will always be whichever is lower, because these are deductions. Okay, so that is 1.3, our initial value, which the lower fair value. Okay, so that was the second step. Now let's go to the third step. The third step is to determine if there are any mortgages paid by the decedent prior to his death. And that's easy, okay? This question is actually easy. So, if there are any paid mortgage, the initial value shall be reduced by the paid mortgage. And it was said the exclusive property which was inherited 3.5 years ago was subjected to a mortgage of 450,000 pesos. That was the amount assumed by the decedent. However, the unpaid mortgage of the property upon his death is only 350,000 50,000 pesos. So therefore, 3.5 years ago to today, there was a total payment of 100,000 pesos. 3.5 years ago, the property was assumed, was received wholeheartedly, but there was a corresponding condition to pay this 450,000 pesos mortgage. However, today, the unpaid mortgage is only 350,000 pesos. So therefore, we can say there was a payment of 100,000 pesos. Okay? Therefore, our initial value, the 1.3 that we have just determined in our second step, will be reduced by 100,000 pesos. So the decedent had already paid 100,000 and the initial value shall be reduced by 100,000 pesos. Therefore, the new initial basis, okay? From the initial value, we go to the new initial basis. And this new initial basis will be the 1.2 million. That is the initial value of 1.3 less minus the 100,000 paid mortgage. Okay? Now let's proceed to step 4. The new initial basis shall be further reduced by a portion of lit. You know what's lit? Losses, indebtedness, and taxes, plus the transfer for public use. Remember, these are the 4 items under the ordinary deductions, and it is said the new initial basis shall be reduced further by a portion of lit plus the transfer for public use. Okay, so how do we do that? So again, that was losses, indebtedness, and taxes. In the problem, we were given unpaid mortgage of inherited property, judicial expenses of 320, and other obligations. There was no transfer for public use. Therefore, we could say we can just simply ignore this because there is none. In the problem given, there is no transfer for public use. But we are given indebtedness. Unpaid mortgage. Is this a loss or indebtedness or taxes? Of course, this is an indebtedness. 350,000 pesos. Judicial expense incurred after the death in connection with the settlement of the estate. Question: is this a loss or indebtedness or taxes? This is not of those 3 items. In fact, any expenses could no longer be deducted from the gross estate. Previous years, in the prior years before the train law, before 2018, actually, that was not lit. That was illit. That was expenses, losses, indebtedness, and taxes. But under the train law, the expenses were totally eliminated. So before, there was expense, but today, in our new law, there was none. So therefore, we will just ignore that. So 350, and of course, the other obligations. Therefore, the total lit is 350,000 plus 570,000, or a total of 920,000 pesos. And that is the lit. We don't have the transfer for public use. Okay? So, let's continue our step 4. So we have unpaid mortgage on inherited property, that is 350,000, and the other obligations, so we have a total of 920,000 pesos. And since it is said in our step, the new initial basis shall be further reduced by a portion. Therefore, this 920,000 will be apportioned by the new initial basis, or NIB, over the total gross estate. Okay? So our new initial basis from the third step was actually 1.2 million. That is 1.3, the initial value, less the paid mortgage, that is 100. So therefore, our new initial basis was actually 1.2 million pesos. And the total gross estate was 6 million. So therefore, 920,000 times 1.2 million divided by 6 million. So the portion that is deductible from the new initial basis is only 184,000 pesos. And we will deduct this 184,000 from the 1.2 million. That is why 1.2 million minus 184 equals to 1,084,000 So this 1,016,000 will be our final basis. Okay? Final basis. This will be the amount to be multiplied by the graduated or diminishing rate. Okay? So let's proceed with step 5. So for step 5, determine the interval between the prior transfer to the present death. So it was said that the property was inherited 3.5 years ago. So let's find out in our table. If this was inherited 3.5 years ago, that means the time or the date between the current death and the date of the prior transfer is more than 3 years but not more than 4 years. Therefore, we will multiply our final basis, the 1,016,000, by 40%. So we will use the 40% here. For step 6, we will just multiply the final basis and the rate from the table. So the final basis was 1,016,000 times 40%. Therefore, the vanishing deduction is 406,400 pesos. That's it. Those are the 6 steps when computing for the vanishing deduction. So here is the summary of how we compute the vanishing deduction. First, the initial value. Second, we deducted the paid mortgages. If there was a mortgage, then any paid mortgage will be deducted, but if there is none, then just 0. And we will get the new initial basis. This new initial basis will be divided by the total gross estate and multiplied by the lit plus TPU. And any amount derived from that will be the deductible portion, and we will use this amount to be deducted from the new initial basis. So new initial basis minus deductible portion is equal to the final basis, and the final basis will be further multiplied by the rate based on the table. Okay, whether 0, 20%, 40%, 60%, or 200%. So those are the transfer for public use and the vanishing deduction. So we have already completed our discussion on the ordinary deductions. We have the lit, the losses, indebtedness, and taxes. We also discussed the transfer for public use, and we also discussed the vanishing deductions. So thank you so much for watching, and I hope you learned a lot from this video, and I hope also that you will watch the other video that we have about special deductions. If you love this video, give me a thumbs up, and if you're new to this channel, please subscribe, click the bell so you'll be notified whenever we'll upload new videos. Bye!